Welcome to Bricks and Banter, the cornerstone of exceptional podcasts. Get ready to dive into the world of real estate with Dylan and Scott on the Bricks and Banter podcast.
Welcome back to another episode of the Bricks and Banter podcast. Excited to be here today, Scott.
It's another good day to be podcasting, and we've got a great guest in here today with Legacy Lending. We have Ethan Jobb.
Yes, somebody who we've wanted to get on for quite a while now. So thanks for joining us, Ethan.
Thanks, guys.
Great to have you here.
Yeah. So I think where we'd like to start, Ethan, is just your history. How did you get in the industry? How did you become a mortgage broker?
Yeah, so Ethan Jobb, I'm with the Legacy Lending team. We're a division of Dominion Lending, so Dominion Lending Centers. So previous to making this jump, we just made this jump over in the fall. But previous to that, I was at RBC. So fresh out of university when I was a young buck, started in 2012. And that's, there's some similarities, I guess, for Dylan and I starting young.
We talked about it a few times.
And
we're not jumping on the old guy commentary right away, are we?
Not yet. It's only 2 minutes, so we're not really making fun of it yet.
All right, not yet. Okay, good.
But it's coming straight out of university, it's tough, right? Because you think that, hey, I don't have enough experience, right? Or what if I get asked this question or that question, right? But you learn quickly. We had a lot of support. So my mom, my sister, my brother-in-law are all in the mortgage financing business as well. So there's similarities there with you, Scott, going through.
Ethan's
adding
Ethan's joined.
Ethan. That's been fun today.
Has your family always been, and do you guys operate as a team?
So we all kind of have our own relationships with our clients, but we share a lot of relationships still with builders, with realtors, with other COIs, lawyers. Even sometimes it's funny being in the business for this length of time. Maybe my mom's helped a client, and then they've gone to my sister, and then they've come to myself, right?
Family tree.
And it's like one of those things that. We're centered here in Oshawa, right, in Durham region. So a lot of people, if you've been born and raised in this area, they kind of know, the family, or they've heard of you before, type thing, right?
I think your last name is pretty well known. Like if I've mentioned you have, we've worked together many times, but I mean, as soon as it's mentioned, it's like, oh, is that the same Marlene? Or there's always somebody who they mention, right? Whether they know you or they know everyone, right?
Yeah.
So when they go from mom to your sister to you, are they just trying to get a better rate, or has it just been a generational thing?
It's just kind of whoever's available, right? And that's the fun part of it is, we never fight over any client or any deal. We want to make sure that we're providing the advice and, helping the client at the end of the day, right? Like the customer service aspect of it is huge for us. But it's funny because, my mom's been in it for, X amount of years, and we were just young, but it was like I was prospecting when I was even in kindergarten. I would ask kids in my class if they lived in a detached or a semi-detached home.
That's amazing. You're like sliding them business cards at trading snacks at lunch.
And 20 years later, now I'm doing some of their mortgages. So it kind of come full circle. But
awesome. Ethan opens his lunchbox and his mom's business cards just fade all over the playground.
They're like stapled to his snacks.
That's awesome. That's kind of part of it. We've grown up with just hearing the conversations of being on the phone and talking about mortgages and everything like that. And now I'm 13 years into doing mortgage financing.
That's awesome.
Holy cow.
Congratulations, man. It's
a
lot of time. Hey, you're almost at 15, right? It's a big milestone soon.
Soon enough. So it was great while we were at RBC. We learned so much. The everything from day one all the way through. They gave us a chance. Like I said, I was 22 years old, so gave me a chance and got to build everything. And just the timing of it, we now made that switch over into the broker space. And as I'm sure you guys can attest to, it's getting harder for clients to get into to properties just with the prices in our area here in Durham. They've gone up, so now we can open the door to more lenders, more programs, some better rates, everything like that. So it's good because a lot of the clients, that's what they want, right?
Yeah, it must be nice to not to like take the shackles off, but to just feel like you have more opportunity to kind of present to your clients, right? You're not so strapped to just the one, types of product or, the one lender, right? Must be a nice little change, I can imagine.
So my other question for you then was, have all you ever worked for was RBC? Like, or have you worked other places in the mortgage industry as well?
No, so all of us, we were all RBC previously.
Okay.
And into the broker space. You know?
Okay.
And that's, you know, making that jump. A lot of people, like a lot of realtors, like when we made that jump, you guys were like, you know, it's amazing. So it's really encouraging. We've had a lot of support, you know, from our family, from our friends, from our clients, from our realtors, lawyers, everybody, right?
That's good.
There's some people that have said, hey, what took you guys so long?
Yeah.
Right?
I'm sure other brokers probably said that to you. Like,
yeah, but
like, what are you doing? You're finally here, right? Like,
it's a big jump, right?
yeah.
Like,
and it's a big decision. That's a huge change, right? Like,
yeah, leaving a big corporation, and you know, we were so ingrained there, but now making this jump, there's a little bit of relief in a way that now we can kind of do our own thing. Yeah. You know, and just help more people. Right.
Yeah, and I think a big piece of it too is like people are coming to you because they trust you. They know they like everybody knows what you're capable of. So I don't think it's really going to matter, you know, if you're here or if you're there. Like they're going to come to you because they know the service you provide, right?
Yeah, and it comes down ultimately to advice, right?
And the support, right? Like,
yeah,
people want to feel that support in this process. We always talk about it, right? Like you don't want to feel like you're alone because it can get scary, right? Like really quick.
Yeah, and I'm sure even, you know, when the client, whether they come to you and they funnel to us, or whether they come to us and they funnel to you, right? Yeah. You want to surround your client, you want to surround yourself with like-minded people that are available, that are going to be able to, you know, pick up the phone, maybe calm you down, or let you know that it's okay to make that jump, to maybe go up a little bit in a purchase price, right? Or if that property doesn't work out, there's another one that's going to come down the road,
and
right?
you can show them the plan to get to that, right? Like,
exactly.
And that's a really good point that you make. Because your advice, our advice as a group might be the same advice. Coming from you, it sounds different than coming from someone like myself or Dylan. Yeah. Like if you say, if you just move up a little bit in the market, you know, you might save yourself a little bit of money or time with not having to buy another house in a few years.
For sure.
That sounds salesy, right?
Yeah.
Just buy the bigger house and spend more money.
Yeah.
Right. So, but when it comes from you, you can say, you know, from a financial perspective, it makes more sense to, you know, extend from 550 to 650 or from 650 to 700 because it gets you into the bigger home, it gets you into the neighborhood you want, it gets you into the school district you want, and you're not looking at moving in 2 to 3 years. Yeah. Right. Yeah. You're able to stay in that home for a little bit longer. Yeah. Right.
And that's like, again, it kind of comes down where we will show the affordability, right? So making that jump, right? Just because like we talk to somebody and they're getting pre-approved, just because you qualify for something, your income supports X amount, doesn't mean that you're going to go out and end up purchasing that.
Yeah, that's
right. A lot of people don't want to spend that number. They're like, no, I have that, but I don't want it. Right?
Yeah, there's that spectrum. And then the other spectrum is, you know, I want this big house and this big purchase ticket item, but how do I get there? Yeah. Right. And that's where, again, we can look at that. So, you know, maybe if the importance of the pre-approval is getting in contact with us so we can show you what that looks like, right? Okay. And maybe that's adding a co-signer to get up to that higher purchase price, or a gifted down payment or something like that. Okay. The bank of mom and dad is really big.
In recent years especially.
Yeah, right?
It's had to be. It's had to be. So you make some good points. So what I thought we could do is we could just jump into some of these questions that we have for you. Yeah. Now, you're the expert when it comes to this now, and you've got a lot more services. So I kind of had a couple questions, and I'm going to turn it over to Dylan.
Yeah. We'll go back and forth like always, right?
Yeah.
But what would you say is probably one of the most important things a first-time buyer can do and prepare for?
Yeah. So right off the bat, you know, speak with a mortgage advisor, get pre-approved, because you want to make sure that what you qualify for, you're going out and looking at, right? Especially if the realtors engage, if you guys are engaged and you're starting to go out and show them properties, you want to make sure that they fall within their qualifications, right? So off the bat, when we collect some of the basic information, you know, your name, your address, your employment details, so we verify your income, make sure that your income, you know, just because you say you make 100,000, well, we have to make sure that, you know, that's verified, right? Because when we send it off to these lenders, they want to make sure that income proof is there.
Ducks in a row, right?
Yeah. Maybe you've only been in the industry for, you know, a year or 2 years, or you've changed jobs or something like that. Those are things that we can work with. So case by case, you income. We're always going to have to verify income.
Yeah.
Then we look at your down payment. So again, your savings, right? You want to make sure that you have enough down payment. Minimum down payment, 5%. Once you get over the 500,000, you're going to have a little bit more. It can go all the way up to the minimum down payment would be like 7%.
Yeah.
Okay.
And that's keeping you within CMHC, so default insurance. And then you can get to a 20% down payment, and that gets you more into a conventional product. And then even further than that, if maybe somebody's selling their property and they have 35% or more down.
Okay.
So verifying that down payment, that's another big one. And that's where sometimes we can help clients, especially first-time home buyers. Do they have an RSP under the home buyers plan? Because that's a good tool that you can pull funds out of.
Hadn't thought about that one.
No, that's a great one. Yeah,
Yeah,
good point. I figured you'd bring that up.
Yeah, there's a first home savers account that's just been launched. So that's another kind of tool. That's almost like a hybrid between a RSP and a TFSA. And then, other avenues of savings, so just a regular savings account, investments, stuff like that. But, that's where I said the bank of mom and dad, sometimes they come in and, that might get those clients, maybe they're looking at 700, but really they need to get to 8.
Yeah.
Maybe that's where they have that conversation with their parents or with an immediate family member after they've kind of done some of their homework with us.
Okay.
That, hey, we're just getting outbid here, right? They've put 5 or 6 offers in and they just keep falling short. Well, let's go back to the drawing board. If you can bump your down payment up, right? Or if you can get support from family or another avenue, then maybe that gets you into that property, right?
Okay.
So never really like ruling anything out. There's always going to be an option.
Yeah, you're trying to find solutions always, right?
Yeah. And that's where because we look at this day in and day out, right? So sometimes clients, especially first-time home buyers, they may never thought of that's even an option, right?
Yeah.
And then you get into, reviewing your credit. So credit's another big one because that will also determine sometimes what your interest rate can be. Your credit is made up of a couple different factors. So sometimes there's misconceptions around credit bureaus. People think, if you pull my credit bureau, it's going to damage it, right?
I hear that. I hear that a lot. So can you expand on that credit side of it?
Yeah. So there's 5 pieces to a credit bureau.
Okay.
Making your payments on time. That's going to be your biggest one. Then it's your utilization. So keeping your balances away from limits, right? So between those two, that makes up 65% of your credit score, right?
Wow.
So that's a big chunk that people don't really realize. And then it starts to kind of teeter off, and the next 3 would be the types of credit you have, the length of time you've had your credit, and then the final piece is that inquiries. So 10% roughly is the amount of polls or the inquiries on your credit score. So
pretty minor, eh?
Yeah,
because when we get out and talk to people in the field or we're out showing houses and like, I don't want to pull my credit. It's going to be bad for it. It's going to be really, really bad.
Yeah. And like maybe they think that, but if they haven't missed any payments or anything like that, then likely their credit should be, good, B+ A score credit, right? But that's something, again, once we are able to review that credit bureau, we have a full picture, right? So maybe it is bruised. Maybe there's something there that we see that you didn't know of. Maybe there's fraud on your credit bureau, right?
Okay.
Maybe there's an outstanding collection item, right? That you don't know about that, you got crutches from the hospital 10 years ago, right? And it's $50 and the hospital has a collection item for you.
Like a library book.
Right? Yeah, exactly. Right? Exactly. So you don't know that until you've reviewed it, right?
Yeah.
And that's something that then we can get ahead of that and start to improve your score, right?
Yeah, that almost sounded like a little bit of a personal story with the crutches. That was pretty specific.
It's probably happened.
Yeah, not to me, but it's I've definitely seen that one.
So
for sure.
I just have one quick question I want to ask you on the credit, on the pulling side of it. So a lot of the times we hear terms, whether it's like a soft check or like a hard check or a thorough check or a light check, whatever way you want to put it.
Yeah.
Is there a real difference in that, or is there anything that you can just share to kind of put people's minds at ease for one or the other?
Yeah, for sure. So everybody can go on like a TransUnion or Equifax and pull their own credit, and that's not going to affect your score. A lot of banks kind of automatically pull your soft bureau behind the scenes, right? Just to kind of make sure everything's in check. Now, when we pull a credit bureau, like that would be a hard check. Now, if we send it off, so we pull your credit bureau and we're going to send your deal to lender A, right? If for any reason they came back and they weren't able to do that deal and we had to repackage this up and send it off to another lender, they're looking at that same bureau. So you're not getting hit on two pulls. We're using that same bureau, right?
Oh, okay.
So there's a
that makes sense.
Yeah, there's a 45-day window there for lenders to use that same original bureau on that same application. And usually it's anywhere from 30 to 60 days that credit bureau has to be pulled for, depending on the lender, right? Some have different rules, but that's something, again, it's, there's some misconceptions, but if you're serious about buying, you want to make sure that, we check that.
Yeah, it's a real check.
Yeah, you don't want to say, oh yeah, I don't have anything, no blemishes on there. And we say, okay, yeah, that's fine. You go out and then you put an offer in, and maybe it's a firm offer, and then now we're scrambling. And,
all of us are scrambling.
Right? And it's, you're changing around that application because now it's not going to, say, the bank, now it's going to an alternative lender because of the credit score, right? Yeah. Which we could have avoided before if we got ahead of it, right?
So again, a common theme in a lot of the podcasts that we've done are full disclosure.
Yes.
Because when you get those little hiccups and bumps, whether they're innocent or kind of more, they're really trying to misrepresent their facts that they have. Yeah. Right. It makes it difficult.
For sure. And it could be you may think there's nothing on there, and there could be some missed payments or a collection item, like I said. So that's something, again, you want to get ahead of. And we would advise clients and try to help them to fix that, right? Give them enough advice to say, hey, let's repair this, because it's not everybody starts an application and goes and buys a property that same weekend, right? Sometimes you're working with clients for 6, 9, 12, 2 years, right? 24 months even, right? So sometimes it's a work in progress, and that comes down to, even when they do get into a property, maybe they end up qualifying and they purchase something now, and we have an exit strategy because we had to go through an alternative lender. They clean up their credit, and then at maturity, because it's a short term, we look to then move them back and get them back to kind of the A side. Right?
See, and I think that's important information to know that, I'm not channeled into a B lender, or, the bruises, they may hurt a little bit, but it doesn't have to be forever.
That's right. Yeah.
Okay.
So before we move on, one other thing, and it's a little bit off the credit topic, but earlier you mentioned CMHC.
Yes.
So can we just open up on that really quickly? Can you just explain what CMHC is and how it may affect somebody purchasing a home?
Yeah.
Just so we get that from the source himself.
Yeah. So CMHC, so they're a default insurer. So there's 3 default insurers: CMHC, Canada Mortgage and Housing Corporation; Sagan, that was formerly Genworth, and there's Canada Guarantee as well. So essentially, you're going to fall into one of those 3 default insurers if you have less than 20% down payment. So what happens is you're going to use, say, just simple math, you're purchasing $500, you're going to put 5% down payment, right? $25,000, that gets added in there. Now, CMHC or Sagan or Canada Guarantee, they're going to add a default premium. So it's tiered once you get from 5 to 10, 10 to 15, 15 to 20%.
Okay.
So that premium is tiered. That gets added to your mortgage. So you don't pay that kind of bulk amount. You do pay the tax on that at the lawyers. So that's another thing too.
Good point. Actually, very good point.
Right? For first-time home buyers, they may not know what their closing costs are, right?
Yeah, it's a little bit extra money. It's coming into their pocket.
Yeah, but they're able to get in, right, with that kind of minimum down payment. So and with CMHC or Canada Guarantee or Sagan with a default insured mortgage, the pricing on that is usually the kind of lowest in the market, because basically the financial institutions are protected, because if you were to default on the mortgage, then CMHC or Genworth or Sagan, they're going to step in and basically clear up that debt, right? So getting into a little bit of a rate discussion a little bit, and this is kind of the flavor of the week because it changes, right, day to day. Kind of who you listen to, what radio station you have on or TV station you have on, where rates are going. But usually that lowest advertised price is like a CMHC insured purchase. So not everybody falls within that bucket. So
That's a really good point.
No, it's a huge point because people don't know these things.
Yeah, right. Like people will throw out rates, and you're like, "That's fantastic."
Yeah, I saw this on a website. It was, I can't believe my guy. No.
Yeah.
Reel it in, right?
Yeah. And
ABC Mortgage was going to give me a mortgage for 3.5%.
yeah, and that's a purchase under $1 million to qualify for a default insured mortgage. So yeah, it has to be 25-year amortization, and usually those insured pricing specials are on a 5-year fixed or a 5-year variable term. So again, depending on your situation, depending on the client's risk tolerance, you may or may not want a 5-year. You may only qualify on a 5-year because that's the lowest rate as well, right?
Okay, gotcha.
So those are all things that not everybody falls under the same bucket, right? We really have to.
It's really timely information too, though, right? Because we think about the rates, everybody's got their guess of where they're going, but I don't think many people, like, tell me if I'm wrong, but probably not a lot of people would want to jump into a 5-year fixed right now because they're hopeful or they're optimistic, right? But if that's all you can get or if that's what you're at, then, that's the situation.
And
right?
that's something too, like everybody kind of has their own crystal ball.
Yeah.
I don't have a crystal ball. If I had one, I'd be on a yacht somewhere.
Trust me, there are no crystal balls in this room.
Yeah, we'd all be doing this somewhere else, right?
Scott thinks he has one, but no, that's just his watch.
Nope.
But again, that's something that, if a client's really adamant that they think, rates are going to be down in a year, next spring. I want a 1-year rate.
I believe it.
Right? Short-term money right now is very expensive. So are you okay with that payment? And do you qualify to carry that mortgage payment? Right? Yeah. That might change once we start showing clients numbers. Maybe they gravitate to a 3-year. Maybe they do a 4-year. Maybe there's a 5-year special. Like it really all depends. And where rates will go, we really don't know. Yeah. I don't think it's going to be like a linear, straight down for this rate environment. And we should start to see it decrease, but you're going to see that hiccup, right? Yeah. Where it kind of goes
It'll trickle
up and down, up and down, up and down, up and down, right?
Yeah, because even someone in your position, you can't predict where the rates are going to go.
No.
Right?
It's just like somebody coming in and saying, "Hey, I'm buying this house for $750. In a year from now, can you sell it for $900?"
Yeah, I would never make that guarantee.
Right? You can't, right?
See, I think just quickly on the same topic, one of the Remax events that I was at, I think it was last year, one of the guys that was speaking on stage, he basically had just said it like this. He's like, look, every single one of us, every day, we have people asking us where are the rates going, and he's like, you know what I tell people? If the chief economists of Canada can't figure it out or they can't predict it, how could you expect a realtor that works in Oshawa or Toronto or whatever to figure it out, right?
Yeah.
So I think anybody, like especially in the social media world, maybe even the podcast world, a lot of people want to make big, bold claims and they want to, be the one that is going to pick and decide everything. But that's what I like about how we do things here is we're not here to do that. We're here to give you our ideas and what we think is going to happen, right? But we're not the chief economists of Canada, and even they don't know half the time.
Well, and I think you make a very good point because we've had guests on here that have always said, partner yourself with someone who is proficient at what they do, right? Yeah. I'm not a mortgage person, right? I couldn't even tell you, like some of the stuff you're telling me now
is new,
right? Like I didn't know there was certain different products or credit approvals or how these things kind of thing. Yeah, everybody talks posted rate. Oh, it's at 6%, it's at 6%, it's at 6%. You keep hearing that and you keep hearing that. And then it's like, oh, I'm going to jump into the market when it drops to 4.5.
Yeah.
Do you want to be homeless for the next 2 years in case it doesn't go there? Like what happens if it never gets there? What are you going to do?
Well,
they're going to hesitate still, right?
Yeah. Right. There'll always be people waiting for something to happen. Yeah. Right. And they're going to miss that boat, right? Yeah. Or miss a train or miss a bus or whatever you want to, right?
Yeah. Your ship comes in and you were at the train station.
Yeah. But like 4 years ago, before COVID, right? Like the Bank of Canada overnight rate, which all the financial institutions base their prime rate off of, right? Yeah. That stayed stagnant for quite some time, 4 or 5 years, right? So and it wasn't something that was in your face every other week, right? Yeah. Like now, literally, when the next Bank of Canada announcement is.
Yeah,
right?
Everybody talks about
accounts with all the
like every 5-6 weeks, you know when it's coming up, and you know when the Bank of Canada is holding, when they're decreasing, they're increasing, right? Before that was like it was still obviously a factor of our business, but now it's just so pushed.
Everybody's hypersensitive towards it.
Yeah.
But as you're describing here, there's a lot of factors that go into this that you really need to take into consideration.
Yeah.
Like even someone like myself, right? Self-employed, own 2 houses, been in the housing market for what now, 30 years? And you're telling me stuff I'm learning today.
Yeah.
Right?
Yeah. That's a can of worms application right there.
But, you know, to also have your back here though, right? Because I got you, you know, like part of this, like that's okay because you align yourself with people like Ethan, like you just said, and that's the idea is like, what is, you know, Dave Coppins, our owner, broker owner, what does he say when he hires new agents? He says, don't wear multiple hats, right? Yeah. Wear one hat. You're a realtor. You're not an inspector. You're not a you know, a lawyer. You're not a mortgage guy. You're not all these things. So, you know, like, don't be too hard on yourself.
And the best advice, people, right? The best advice you can give to someone is call Ethan Jobb or call your home inspector. And we've had Tim Palmer on here as a home inspector, right? And they're like, well, what do I do about this with the panel? Well, I don't know.
Call Tim.
I'm not an electrician. And even Tim's not an electrician, but you know, you go through the steps of saying, okay, I don't have the information for you, but I'm going to put you in touch with someone that does. Yeah. And then they open up that box of information a little bit more. And then once that box is opened up, then you can say, okay, you need an electrician to handle this, or
you need that specialist.
You need the mortgage person to sit down and talk to you because you do have some bruised credit. I mean, even like someone like myself can say, you know, well, if you have had a bankruptcy, there's a good chance that you might not approve for that mortgage rate that you just saw on the internet, right? So,
but like that's now on this side, we have options to help those types of people, right?
Okay.
With bruised credit, right?
Yeah.
So that opens up quite a few. Before we were just kind of linear. We kind of had like, you know, the one kind of product and one simple rate sheet, right? Now we can go out and we still have access to banks. We have access to monoline lenders, which would be basically a financial institution that just does mortgages. Yeah. Then you have kind of your next bucket would be your alternate lenders. So they have programs where you can do extended ratios or self-employed or multiple rental properties or well and septic or acreage or whatever kind of unique situation you may have. And then we even have access to private or mix. So these are all things that now anytime a client throws something at us, right? We can then take that information, do what we need to do with it, package it up and say, hey, here's your option, right? So that's something too that allows us now. Like it just helps you guys, right? It helps the clients. The clients are okay with exploring an option that they don't know the ins and outs of what we can do for them, right?
Yeah, and at the end of the day, it's in their best interest, right? Like you're showing them like we have these options. Let's review them so you can make that informed decision, right?
Yeah.
So do you still find then that there are people out there that are bank specific, they're brand specific, like they've channeled? You know, I've always banked with the big blue bank. I've always banked with the big green bank. Yeah. Right. I'm not throwing any names out here, but
like
you know what I'm
RBC
getting
TD.
to. Okay. All right. Fine. Fair enough. Then you know, I've always been a BMO guy, and I've always been a CIBC guy. Yeah. Right. And there's no real rationale other than, you know, I opened an account when I was 18, and I've been there ever since because I'm not motivated to change.
A lot of people are like that.
Right. Like I'm like that. Like I put everything into this one channel. It's like, whoop.
Yeah, and you're ingrained there and you're comfortable. Now, the other thing kind of that we've started to see is there's turnover everywhere too, right? So there's sometimes when you're going into, say, a bank, you're dealing with, you know, your person. Yeah. Well, what happens if that person retires or gets a promotion or changes financial institutions or changes careers, right? Yeah. Then you're scrambling again, right? Yeah. So that's where now on this side, we can still position it at, you know, select few banks and then the other side of things. But now we can say, hey, what's more important to you, right? Can we save you thousands of dollars? Or do you just want to hold something here just to have all your eggs in one basket, which is perfectly fine, right? Yeah. People can do that. But again, it just kind of comes down to the client situation and what options. And we're the first ones to say too, like, hey, if it makes sense to stay where you are, stay where you are. We've dealt with that. We can give advice to people, and if they end up even in our previous, you know, role, we'd say, hey, here's our 2 cents on it. Look out for this, look out for that, whatever. And if you stay where you are, that's great, right? Maybe we can look at it in 3, 4, 5 years when you're up for maturity, right?
Okay.
Yeah, it depends on what you feel is best, right? Like if you can give that advice, that's also operating from like a position of strength, right? Like you're not trying to like, pull a business and all that. You're saying, look, if it doesn't make sense now, let's do it in the future, right?
Yeah,
That's what we want to hear.
And
right?
I think I think that would be the genuine advice people are looking for, right? It's always, in our industry, it's commission rate. In your industry, it's interest rate. Everybody's got their little trigger where they think, I've been groomed to ask this question, or I've been groomed to say that this is the most important thing. And I'm leading you a little bit here, but it's not that one key factor that's the most important thing, because you do have more products. You do have more services. So can you expand on that to say, this is the benefit of, having these products available to consumers? And it's not just interest rate driven.
Yeah. So like, here's a kind of an example. Say somebody's self-employed, right? And they're incorporated. So if you're incorporated, you may only be pulling out X amount of income per year for tax purposes. So it covers your kind of household expenses, right? But your company might do very, very well, right? And you can afford more than what your income supports.
Kind of think he's talking about me.
I'm looking at you.
I'm like, why do I feel uncomfortable all of a sudden?
Right? So a self-employed client like that, right? We might have to go down, say, an alternative channel. It might not fit within the bank because they might not claim all this income on their T1 generals and notice of assessments, right? But they are very well off, right, with their business. So you can go through the alternative channel. You might be paying a little bit higher interest rate, but that difference, like what you would have to pull out of your business, hundreds of thousands of dollars to qualify for that mortgage amount, right? Then you're paying income tax on that. So these business people are okay once you show them the math. They're okay with paying a little bit higher interest rate versus paying income tax, right? And pulling a way higher income. So that's something too, where before we were just kind of stuck within, maybe you could gross up your self-employed income by 15%. Maybe you could do a stated income program, but then you need, way more down payment, right? So, and then you'd be restricted there. Where on this side, you can do like a business financial statement program, right? So you can see this coming in. You can see that the serviceability is there for these clients and get you into it's kind of like it's a better product for that specific client, right? Where if you're two teachers and, you're on a salary and you have no debt, well, you're probably going to land in that, bank avenue, right? Because you're within guidelines and, here's the rate and away you go, right? So they would never kind of fall into that alternative side unless they had bruised credit, let's say, right? So it really all depends on the client scenario. But those are simple things that, you might not think of that we could, once we start discussing with the client, we're going to uncover different information than what you guys uncover when you guys are sitting down speaking with your clients across the desk, right? Where on our side, we're looking at your full financial picture. So we're kind of having the same conversation. Like the end goal is the same,
more
right?
serious.
The end goal is the same, but it circles back to the point I made earlier. Coming from you, it sounds different than coming from us.
For sure.
Right? Like I find people are more willing to share information with someone like yourself. Than they are willing to share with it's almost like they're giving away too much information to us, and they're giving away their point of leverage.
I think that's fair though, right? For some people, not everybody wants to, not everybody, even if they're really well off, not everybody would want us to know their full picture, even though we kind of do, because we have to know to some degree, right? Like we don't need to know, you don't need to see the statements, but we do need to have a rough idea, right? So like you said, like if they trust Ethan or, whoever they reach out to, if they trust them, they feel comfortable, they know that like if they share it, that it's not going anywhere, right? It's private, it's confidential, like you're their financial person, right? So I think some people just get a little worried, they don't want too many people knowing their situation, right?
And like that's something too where like the information that we gather, we're not turning around and sharing that with you guys.
Not even with us,
right?
exactly. And that's a big piece.
It's sometimes a phone call, you guys pick up the phone and say, hey Ethan, can these clients go from 1.1 to 1.15? Yeah, we can make that work.
Exactly.
Right?
Like, but you're not like, here's the statement.
Yeah,
see
like this is the proof of they can do it.
Yeah.
But it's a conversation, and that's the good part when you guys as realtors and us as mortgage advisors, we have open communication and we're helping the client. So the client may not know that all those conversations are going on, but we're both working in their best interest to get them into that property, right? And then we can both confidently say, hey, I spoke with Dylan and, you know, I heard you guys got that house. Thanks to, you know, the conversation that you guys had and right. And that's especially now with, you know, we're getting back into the multiple offers and, you know, clients are putting offers in and losing out, putting offers in and losing out. Right. Like, and that's going on. So we're talking to that client way more. And that's one thing that I always say to clients, like, hey, if you're going out and you're dealing with Dylan or Scott or whoever the realtor is, let me know when you're going to look at that house and if you're about to put an offer in. Because let's rerun these numbers. Let's get it back fresh. Exactly. It doesn't take us, you know, we've done the legwork of building that application. So we know where it's going to be. You know, you might be at 800, you might be at 825, you might be at 790. Okay, well, I know it's not going to change much, but let's, you know, home back in. Yeah,
because you're going to then look at the taxes, right? You're going to look at the various factors that they're going to affect that, right?
Yeah, like the collateral piece, like the property itself. Every collateral is different, right? So square footage is different. The property taxes are different. Purchase price is different, right? So those are all things that then we're up to speed, and then it's a matter of if like there's conditions in there, we already have a step ahead. So then we just need that accepted offer and we can send it off. Maybe it's, hey, can these clients go in firm, right? Maybe they have a house to sell. Maybe, you know, there is blemishes on their credit. Maybe their incomes, you know, they're new or something. Like that's something where we then provide the advice to the client for them to make that decision if they are, you know, going to go in and put an offer in on a property, right?
Yeah. So like you said, it's coming back to that point of, you know, helping the client and then helping them get there. But even when you were talking, I can see elements where we're protecting the client too.
For sure.
No, if we've had a quick conversation and someone absolutely falls in love with a house, you know, I'm willing to pay anything. Not, down a bit.
Careful.
Down a bit. Right. Because if you get them into a firm offer and let's say you go that threshold and you've said, look, their max is 875. They're in trouble at anything above that, that number. And they get into a competitive situation. They love the house. They don't want to give it up. And all of a sudden, the next thing you know, you're dropping 925 and then it lands back in your lap. And you're like,
how did this happen?
Right. Then we have to kind of go back to the drawing board.
Well, now we have just enough information to help protect them in the market so they don't get carried away. Yeah, I can help you if you've missed out on 3 properties, but I can also protect you from overshooting a little bit too. Without, like you said, knowing their financial bank statements and everything.
You know, like multiple offers and when clients are up against competition and they're very emotional in that time, right? Like I'm sure you guys would see it more than us, but like, you know, we hear it kind of the next day or, you know, 9 o'clock at night or whatever it is, right? But like maybe those clients are still within guidelines. They have a number in mind that they don't want to exceed.
Right.
But they are okay because going up that extra 30, 40 grand to get that property, what's that going to do in a payment? You know, like can you handle $50 biweekly? Right. It's a case of beer. It's a night out. It's it's a Netflix subscription,
Uber Eats, whatever,
Uber, right? Like it's when you start to put it into perspective that way, clients are then like, okay, it's not that scary.
Yeah, I can just go out to dinner once less a month. And still afford this house.
Like prioritize where you're spending your money, right? And if that property, if you're emotionally attached to that property and you want to take that on, this, you know, you can do it, right?
And I do find that's what you do get an emotional
big time
process sometimes. And it's, you know, I kind of always came back to that, honey, don't let them buy my house, right? I want this house. Like, this is where I want to raise my family type of thing. Or the dad sitting there going, this is the best garage I've ever seen, right? Because women and men buy houses differently, right? So there's different motivating factors. And if you got the perfect garage and the perfect house to raise a family, and we're not losing this one, right?
Well, and I think it goes back to the piece of just like surrounding yourself with people that are like yourself, or at least are working very professionally, right? Because we know it from dealing with other realtors and other mortgage specialists, agents, whatever, right? Same as you probably have dealt with other realtors, where when you have somebody who's a professional in your corner, like us having those conversations, like, hey, Ethan, we're putting this offer in today, you know, we're thinking 775, you know, can you just double check one more time, right? Like that like it gives the client, but it also gives us so much confidence too, right? Because there's been so many situations that I've dealt with, I've tried to refer you or someone else, and it's like, oh no, I have my guy, right?
Yeah.
And then their guy is just unbelievable. Like, is he
like
asleep?
nowhere to be found?
Yeah,
maybe,
is he asleep
right?
for a week straight at times? Is he just, he doesn't even answer a text for 2 days, right? So the point is that when you're in that stressful moment, right, when we're typing up that offer, we're about to put it in, like, it's stressful for us as well. So to know that we have that confidence, it's almost like a second layer on top of the client. Like, they hear it from you, but they hear, I talked to Ethan, we're good, right?
Yeah, and that probably helps you guys with dealing, say, if you guys have your buyer, right, you can negotiate because you're more confident because you spoke with us, you spoke with the client, you know that everything's good. So it's not just taking the client's word, I can go up an extra 50 grand, right? Like, what if they literally didn't have that 50 grand?
Yeah.
Right?
A lot of people have that false confidence at times. Oh yeah, I'll be fine. No. Let's just make sure, right?
And there's been times too, on a listing side, where you're representing the seller and all these people are throwing money at you.
Yes.
Right. And you've known from talking to someone like you saying, the highest price isn't always the best price. If the agent on the other side and the consumer on the other side or the buyer on the other side says, I've already spoken to my bank, or I've spoken to so-and-so at, the big green bank or BMO or CIBC, or our mortgage person is Ethan Jobb. Like, oh, okay. As a listing agent, I'm kind of sitting there going, okay, well, now I know that there's a lot of legitimacy behind this offer. Even though this one's more, at 20,000 more, there's a good chance it might not close. So the money is enticing, but we also want to know a little bit more about what's going on in there. And again, it comes back to partnering with people that do have your best interest at heart. They're not driven by anything other than their client getting the best result. I think that's key, and it's important.
Yeah,
definitely.
To that.
And I think it comes back to us too, right? Like, when you're operating as a listing agent, like it is, to some degree your job to get as much information. Like, a lot of realtors will not ask multiple questions about the buyers. I feel like you've probably dealt with it as well, but some of them will ask you 10, they have a whole list of questions, right? So it goes back to us too, right? Like, if I'm calling you on a listing and I go, Scott, like, got these buyers, Ethan's dealing with them, you would instantly be like, I trust these buyers, right? Like, the facts are there, right? So they're big pieces, I think.
Well, because there's a lot of things in the industry too, and we've all seen the CBC marketplace pieces where all of a sudden there's a whole thing on mortgage fraud, right?
And which is massive. Fraud for shelter is huge, right?
What did you call it?
Fraud for shelter.
Fraud for shelter. There's actually
I've never heard that term either.
It's a real thing. Like,
wow.
Yeah, it's massive, right? Like any of the big GTA, right? VTA, Vancouver greater area, right?
Yeah.
It goes on all the time, right? And that's something too with the previous experience that we had with RBC. They've taught us very well, right? Like, we're collecting docs up front, we're verifying clients. We're going through all that due diligence, and all these lenders, they're looking at documents more and more, right? Through like everything that they're calling employers. They're asking for pay slips, T4s, sometimes even notice of assessment, like 3-4 layers of documentation to verify, right? Down payments, where money's coming from. If it's coming from an external source, if it's coming from overseas, right? Like, there's things that they have to protect themselves, because where is this money? Where's the money coming from, right? So
that almost sounds like another topic all unto itself. Like, it sounds like you could talk for hours about that.
Well, I feel like we could open it up slightly and then leave it at that. Like, do you have any tips maybe that either current homeowners could maybe just take to protect themselves from potential mortgage fraud, or new buyers? Like, anything that someone can do to protect themselves, or is it just like align with the right people?
Yeah, I mean, aligning yourself with the right people for sure. But when clients are going to the lawyers on a purchase, you want to make sure you have title insurance on that property, right? That's going to protect you down the road. Even if you don't have if you're free and clear, you still want to have that title insurance, right? But like the fraud for shelter would be more like fudging income documents, right? Which you never want to participate in, right?
No,
like you
of
don't want to
course,
even surround yourself with that. But
I guess the reason I kind of just brought it up in that way is that I had probably 5 or 6 phone calls once this all kind of started being a thing of previous clients who own homes who were like, Dylan, how do I get title insurance? What do I do? What do I do? And it was usually I was just kind of saying, you know, here's your lawyer that you dealt with, reach out to them, connect with them, get it, you know, they'll give you the facts, right?
For
But
sure.
I guess I just wanted to see if there were maybe any other pieces to it that, you know, even we might not know, because as we said, we don't know everything either, right?
Yeah, I've never even heard fraud for shelter. I mean, you just hear the marketplace thing, right? So
yeah, well, that's the same. Yeah, same thing. I guess it's just terms on our side, right?
Yeah. No,
that's
it's
your side.
again, it's aligning yourself with good people, so that you avoid that. I'm going to go in. I don't know if we're backtracking here a little bit, but it's I don't know if we covered it. If we did, just redirect me. But the importance of being pre-approved.
Yeah, so that we kind of got through, I think, the majority of it, and then we kind of went down that tangent there. But yeah, verify income, check credit, make sure you're within the qualification guidelines, and then you know the collateral piece itself. So the house, that's obviously with a pre-approval. Yeah. We're estimating, you know, property tax, heating, purchase price, stuff like that, right? So when it comes down to, hey, you guys are pre-approved for, you know, a purchase of $850 with your required down payment, right? Okay. Again, we're going to keep that within conservative guidelines, right? Yes. Because a lot of the times when you give somebody a number, they're going to push that envelope and, you know, buy higher, right? Because they're going to look at homes that start at $849, right? Yeah. Knowing that you guys know that it's going to sell for $879 or $899, right?
Or $980.
Yeah, or like way over. So that's something where, again, you know, hey, you're pre-approved. You know this is what the payments are going to be. Hopefully, your worst case scenario on the high end, right? Yeah. And then that allows the client to then go out and shop confidently with the realtor, right? So you guys are going out and showing them properties within their price point, right? Not exceeding their price point. And then that also gives us the ability to then start, you know, locking in rates. We're in a decreasing interest rate environment here moving forward. So, you know, anybody that if they're purchasing 120 days out, hopefully we're able to float them down and get them a lower rate when it's, you know, if they're closing at the end of June, right? Yeah. Where if somebody's buying now and they're doing a 30-day closing, we're going to get you in and, right?
Yeah, you have to, right?
Yeah.
So I have another question about the pre-approval. We always hear about pre-approval being more along the lines of your first-time home buyer. But I'm kind of getting the impression if you've lived in your house for 10 years and you want to move up in the market or you want to move laterally in the market, you still have to get down. You still have to get pre-approved.
Yes. Oh yeah. Very, very strongly advised to still speak with your mortgage advisor. Right?
Yeah. Because I get this impression that once someone's been in the market for X number of years, they become an expert. Right. And it's like, I know my house is worth, you know, $1 million and I've probably got $200,000 or $300,000 equity in this house. So I'll be fine.
Simple math, right?
Yeah.
But not always the case, correct?
No. Yeah, because maybe those clients, they could have qualified when maybe both the people, like in a downsizing scenario, maybe both of them were working when they got into that house. Maybe they have a secured line of credit with a, you know, low balance or their mortgage is low or something like that. Yeah. But now they're retired and one person's working part-time, right?
Yeah.
Now, if they still need a small mortgage, maybe they need a bridge loan, right? Maybe they want a secured line of credit because they buy that property and they want to inject some more money into it down the road or something like that, right? Again, it's unless you're going to be free and clear where you're selling your property and then you're not needing a mortgage, right? Yeah. If you're still going to have a mortgage there, you need to be pre-approved so that then you know exactly what's involved. Because sometimes you forget. Maybe you forget that there's land transfer tax, right? Or a legal fee. Or, you know, some of your other closing costs, right? Maybe your mortgage is portable. Maybe it's not portable, right?
That's a good point. What does that mean? I mean, I know what it means, but I'm just asking the question. I'm being a little bit leading here, but portability of a mortgage?
So portability of a mortgage. So taking your existing mortgage amount and that interest rate, and then say you're increasing your mortgage amount.
Yeah, so maybe it would be like a first-time buyer who had their house and now they're a first-time seller moving up.
Yeah,
right?
exactly. So they're adding $200,000 to their mortgage amount. Yeah. What's going to happen is they're going to blend their interest rate, right? Okay. So you're going to keep the majority of your funds, your original mortgage amount at say X rate. Say you know, say you bought in COVID, right? And if your rate is below 2%.
Yeah.
You are wanting to port that mortgage
Yes,
100%,
no matter what.
because you're going to add on your new funds, in and around 5%. Your blended rate's going to end up in the 4s somewhere, right? Again, depending on how much you're adding, you can port decrease, you can do a straight port. Some lenders allow you to port, some lenders don't allow you to port, right?
So what happens if you can't port the mortgage, as we're talking about it now?
Yeah, so then you'd have to look at options where if you can't port that mortgage, you'd run into a penalty. Depending on your term that you have, if it's fixed or variable, open, closed, you might run into a prepayment penalty, right? Now with that, it has to make financial sense, right? So that kind of gets back to sometimes these very low interest rates. There could be a bona fide sale clause in there, right? So you can only move your mortgage or change your mortgage if you sell your house, right? So if those people are looking to refinance and do an addition or improve the value of their house somehow, there could be conditions in there where they're stuck because they jumped for the lowest possible rate and you can't make any changes to it, right? So again, that's something likely we're not going to put a client into a product like that. But again, that's kind of awareness as well, right?
See, I'm just thinking here. So we just recently recorded an episode with Jay Asher, who is a mortgage broker, insurance broker that Scott's dealt with for many years. And a big thing we kept saying was, read your documents and understand what you're getting yourself into, right? Because while I'm saying this and while you were speaking there, a big piece that I'm hearing that wasn't being said is just, you have to be aware of what's coming, I guess. So a lot of people I find will kind of wait up until that last month to deal with their renewal, or they're like, they get the email and they're kind of like, I'll get to it. But if you have somebody like yourself that you're keeping in contact with, you're going to be prepping them, for months up to that, right? To ensure that they're up to date. And it's just so important because I do it as well. A lot of us, you don't read everything, right? Even if we're in this business, sometimes you skip over things and you get a little arrogant, right? And a lot of consumers I know, like we're talking about, don't worry, I'll be fine. And then what if you get there a week out and you're like, oh my gosh,
I'm not fine.
And that's kind of like the trust aspect, right? Like if you guys are referring somebody, you're obviously going to trust them, right? If we're referring somebody, we're going to trust them. Know that you're aligned in the same way, that you're not going to put a client in a situation that's not beneficial for them, right? But it happens all the time, and that's I try to lay everything out for clients, right, from the get-go to say, hey, these are maybe what fees are involved, right? These are your options with prepayments. So making double up payments or a lump sum payment, or that portability option, stuff like that, right? This is what you can refinance.
I can't write all these points down fast enough. I can't remember them all. I got to write them all down.
We
so many.
You touched on a lot of good stuff there. It's great.
So on the portability, you mentioned something about a penalty. Like, are we talking
potential
penalty? Okay, potential penalty. Are we talking like $1,000? Are we talking $1,500? Are we talking substantially more than this? Like, what are we talking about?
Yeah. So generally, the way that lenders will work, if you're in a variable rate mortgage, it's always going to be a 3-month interest penalty, right?
Okay.
If you're in a fixed rate, it's the greater of your 3-month interest or your interest rate differential, right? So interest rate differentials are kind of what your rate is and then where the rate is in the market with your remaining term, that difference over the remaining term that you have left, right?
Gotcha. Okay, so that makes sense.
So anybody that's kind of breaking their mortgage that got a mortgage in the last COVID 3-4 years, they're going to have a very low rate. If they're breaking their mortgage, it's going to be a 3-month interest because now the financial institutions can free up that $500,000 mortgage at 2% and now relend it at 5.25 or 5%, right? So they will say, hey, 3-month interest. If you're locked into, the high 6%, let's say, when the peak of the market, and in a year from now, the rates are down low 4s, that could be 2%, and you could still have 3-4 years left on your mortgage. That's where penalties start to get hefty.
Yeah, that would be.
So that's you're sitting at a difference of saying, okay, I've been here for X number of years. My mortgage has been paid down, but I was also pre-COVID or during COVID saying, I'm paying 1.85 or 2.15% versus now. So you could have even a lesser amount because the interest rates are so much higher. Your penalty could be higher. Is that what I'm understanding?
Opposite. If you have a high rate and now rates are low, that's where the big penalties come into play.
They have to make up the difference, right?
Yeah, essentially. It's like buying a cell phone. If you walk out of Rogers with your cell phone and smash it,
Yeah.
you owe $2,000, right? Like that's just what it is.
Instantly.
It's like what it is, kind of putting it into,
Yep.
you know, similar terms.
Yeah.
People
That's a good way
do
to put it,
that
actually.
where, you know, you go in after a year and you're like, I still owe $1,500 on my cell phone.
Yeah.
Right.
Yeah.
Like,
Wow.
and people don't think about that.
No.
But that's just the reality. So you can kind of bring that into this side of things. But we would, if somebody is at a lender and making a move, we're going to, you know, pull up their mortgage and get their statement and figure out what, you know, what their options are, maybe with that specific lender, or we're going to get them a call, figure out a penalty. If they did have to break that and leave, we're going to factor that into the calculation, right?
Okay.
Because again, we want to make sure that if you're buying and selling, not just first-time home buyers, but buying and selling, what you're coming out of your sale with, right?
Yeah.
If you have to pay off debt, if you have to factor some of that stuff.
Yeah, the more we talk to you, I mean, we could probably have you back 7 times over the next course of a
And
little
we
while
definitely will
there
have you
and
back,
just go
that's for
through,
sure.
through some of this information, because if anybody's listening to it, I mean, I know I've got questions that would come up, and my questions are generally geared to, you know, trying to answer a client's question or preemptively say, you know, if I'm out there saying, yeah, you know, when I talked to Ethan, he said this and he said this, that's great, but you need to call him back.
Yeah, I think
Because what you're explaining to me is beyond my scope.
well, you said that earlier where, you know, you guys need to be realtors. Right?
Yes.
Right.
I need to be a mortgage advisor. I can't be a realtor, right? And that's the same thing when it comes down to, you know, what should we do with this condition? Or, you know, what about the septic or the well or, right?
Yeah.
Whatever that, the property specifics, that's where you guys come in,
Yeah.
right?
And that's where we say, call this person, call this person. No, that's not me, right? Like it's back and forth.
Well,
right?
we added
experts.
experts to our conversation the other day, because I always used to go, well, if you're buying real estate, you need a good mortgage broker or a mortgage person, you need a good lawyer, and you need a good realtor.
Yeah.
And then we learned, you need a good insurance person too, because there's a lot of things within your personal liability and your home insurance that needs to be covered. So again, read those documents, find out what you're getting in there, read your mortgage documentation, speak to a professional that's going to allow you to port that mortgage. If you do, let's say you move to a rural property and you think having a hobby farm is going to be the greatest thing since sliced bread, and you find out, I don't like farming.
Well, lenders don't like animals.
That's a good start.
So
Okay, sounds good.
Yeah, that one's always a tricky one, but
Yeah.
right?
But you know, you get people, and I talk to people all the time, and they're like, oh, my dream is to buy vacant land and build my house and build my retirement, you know, a dream castle, and whether it's on waterfront or whether it's on acreage. I'm like, well, hold on, you know, buying vacant land is vastly different, or moving to a hobby farm and having, you're going from a system that is, you know, municipal sewers and no septic and no anything else. Like everything is kind of just move-in ready.
Yeah.
Now you're moving to a property. You got a septic, you got a well, you've got agricultural issues,
Probably
you've
an
got
old
acreage.
house.
Yeah, you've got an older house. You've got lots of things that are probably not working in your favor.
yeah.
You know, to help with that kind of stuff. So you kind of really need to be prepared on that.
Yeah, so that's where, like, you know, pick up the phone, have a like, if it's a quick, easy question. Like we say this to first-time home buyers all the time, but it is for everybody. Like, there's no stupid questions. There's no dumb questions. Like, right? Because everybody, maybe you've done this day in and day out, right? Maybe you've bought and sold 20 homes or have investment properties or whatever. Maybe you've bought and sold once, right?
Yeah.
And it was 20 years ago. Like, right? You can pick up the phone, and if we can help you one way or the other, right? And you go back to your guy or girl or bank or, you know, wherever, that's fine, right? We just want to make sure that we're providing that sound advice and, right, getting people into homes and helping one another.
Okay. All right, we've covered a lot. If you got, I've got a few more quick questions that I want to ask.
I feel like we could open up maybe just quickly on mortgage products. Like we have a couple points on that, just maybe about differences between, you know, fixed rate and adjustable rate, or like just really quickly on that, and then we can move on.
Yeah,
do that,
if for sure. So like, if you want to get into the different types of
so if I were to refer somebody to today and they were a first time buyer, you know, just maybe the products or the options, like the initial kind of products or options.
Because the terminology that gets thrown around, but I don't think it's understood, is like fixed rate, variable rate.
Like a fixed versus variable, open versus closed, for sure.
Yeah.
So a fixed rate, you're going to keep that rate for the length of the term. It's not going to change. It's not going to go up or down. So that is generally a 1 to 5 year, 7 and 10 year, right?
Yeah.
before it was basically everybody was taking a 5-year fix through COVID in the last few years, right?
Yeah.
Taking a longer term because the rates were super low.
Yeah.
Now, it again kind of depends on the client situation. Short term, like that midterm 3-year money is kind of where some people are landing. Some people are forced to go, that 5 year. Some people want to go 1 year because there's the exit strategy because maybe we're
like you mentioned,
fixing up their credit or something like that, right?
Yeah.
So that fixed payment, exactly where you're going to be at the end of your term. So in the 5 years, you know where your mortgage is going to be.
Changes, right?
You know what your payment's going to be, and right.
That's quick. Yeah, you saw that. That's quick. Reflexes.
So some people want to know exactly at the end of the day what their mortgage is going to be and not have any surprises, right?
Yeah, that I would fall into that category.
Yeah, that's how I was too, right?
Yeah, a conservative, right? It's fine. The variable, kind of trending before, the variable usually was lower than fixed, and that's kind of where you would start to pay your mortgage off a little bit faster. In the long run, variable's kind of always one, right? If you were to race to pay off your mortgage, right? The variable is based off of that prime rate and the Bank of Canada overnight rate. So that we have seen drop through COVID, and then now it's gone up 13 times or whatever it was. And we're waiting for that to start to come down, right?
Yeah.
Prime rate affects not just variable rate mortgages, but secured lines, unsecured lines, any variable rate loan. So with that, if prime were to go up or down, your interest rate, usually you have a discount off of that prime. So prime's currently 7.2 as of today. You might have a full 1% off or 0.5% off, right? So that might bring your rate down to 6.7 or 6.2, whatever kind of bracket you fall under, because you keep that discount for that 5 years as well. So that's what you're negotiating on that variable rate.
That's good.
So with the variable, you have some options. You can also look to convert over to a fixed rate, whatever they are at that time. So say 2-3 years go by, you see fixed rates come down, you want to lock in, you could then convert that from a variable into a fixed and basically renegotiate and flip it over, right?
So if somebody wanted to do that, is there penalties involved or any?
No, so some lenders only allow you to convert back into a 5-year. Most, whatever.
Yeah, so they may have their own set of rules with it.
Yeah, but no penalties for that.
Okay.
It's basically just like a renewal, essentially, right? But it's converting from a variable to a fixed, and you'd have your 3-month interest penalty if you were to break the variable. So that's attractive for some people going that way, or the people that kind of have the crystal ball that know that rates are going down soon, right? But sometimes those people don't always want to convert over to a fixed at that time because then they think the rates are going down further, right? So it's kind of like if you're taking
those
variable
experts out there.
Sometimes it's worth riding it out the whole way because that's your initial kind of like risk tolerance at the start. You're like, hey, I'm going to ride this out because it's lower than fixed, so let's go. Sometimes people like through COVID, some people were smart and they converted their variable over to fixed before they got up to the 6%, right?
Others didn't.
Others didn't, right? But that's
why are you looking at me again?
I just looked at you naturally, but then you gave me the side eye, and I'm like, oh yeah, that might have been you.
But that's where like sometimes we can come in, and if we're in touch with our clients on a regular basis, right, or mutual clients, that we can say, hey, let's reevaluate, let's do a mortgage checkup.
It might be worth it.
And see, is it worth like converting this? Is it worth breaking it? Do you need to refine it? Do you need to pull equity out? Are you looking to buy an investment property or a cottage or a boat or a new vehicle or you know what I mean? The list goes on and on and on. So that's where, again, coming back to the advice piece, if we're in contact, like our phones are with us 24/7. So shoot us a text, send us an email, give us a call, and we're able to answer any questions, right?
Yeah, sure. No, that's terrific. So one of the things I've heard a little bit about is, assistance for first-time buyers. Is that a myth, or is that something that's actually out there? Are there programs for first-time buyers?
There was a program where the default insurers were helping with a portion of the down payment. That actually is dissolving at the end of the month, so that's no longer. It wasn't really used. There was restrictions that basically didn't fall within, there was income level and stuff like that in this type of market where we are,
Yeah.
I think they launched it 4 years ago. Like we didn't even have anybody use it, right? That's why they're kind of dissolving it. But other than that, like first-time home buyers are going to be exempt from some land transfer tax on their purchase. So that's a big one for them, and that's all done with the lawyers, right? And then your home buyers plan with your RSP and that first home savings account as well. Those are plans that, again, if we can get in front of these first-time home buyers and have discussions with them, maybe their cash, maybe their savings just sitting in like a regular savings account, not doing anything for them.
Oh, okay.
If it's in there for the 90 days, we can, maybe advise them, hey, why don't you move that over into an RSP or that home savings account? There's limits on both of them of what you can transfer over.
Sure.
But you're going to get tax like benefits from that, right?
Okay.
So you're going to get a tax return that in that year,
Again.
right?
Yeah, just another reason to give you a call.
Yeah, and like sometimes it happens where clients don't know, and they're like, oh, the investment advisor's like, oh yeah, just dump that in there. Well, they're in the process of looking for homes, and they want to close quick because they're first-time home buyers, and they want to get out of the basement of mom and dad, right?
Yeah.
So they're like, hey, we're comfortable with a 30 or 45-day or a 60-day closing. Well, if they just move that money over into there, you got to wait 90 days.
Yeah, it doesn't
right?
work.
Oh,
So,
okay,
so we
gotcha.
have run into that a few times.
Okay.
It doesn't take too long. You can always push that closing date out an extra 30 days or whatever it is. But sometimes clients, first-time home buyers, they get in kind of hot and heavy, and they're like, yeah, we'll just do this, and then they don't really understand or read that fine print, right? So that's where, because we see it day in and day out, we can advise them and say, hey, these are the do's, these are the don'ts, these are the advantages, disadvantages, right? So it really, when it comes down to having that conversation, it's, there's a wealth of knowledge talking to you guys, talking to the mortgage advisors, and that's going to set the client up to make it easier, right? Like it's scary to go out and buy your first home or your second home or your 10th home, right?
Every time.
It doesn't matter. Everybody's kind of, it's the same end goal, but hey, these people deal with it every day. So they're going to be able to give you advice, right? And that's going to help you make that process smoother and easier.
Yeah, I know Dylan and I have talked about it. When I moved last year, I was the worst. Yeah. I couldn't I couldn't follow my own advice.
Yeah.
Right. I was so, but it
comes naturally to you when you're advising clients to do it. Right.
And then when I'm actually moving, I'm still advising my clients to do it. Like I'm moving at the same time my clients are moving, and I'm telling them what to do, and I'm giving them the advice, and I'm pointing them in the right direction. And I go home and go, oh, phew, thank goodness that's all over. And then I sit there, I was like, oh, I didn't do any of that myself.
Yeah.
Right. And it's
like read your texts back to yourself, or
well yeah, it's
what did I say to him again?
I'm my own worst client because I don't follow my own advice.
Hopefully you gave yourself a good review though.
Yeah,
the Google review is not bad. Yeah, the Google review is not bad. My wife's review, not so much.
Not both happy clients, I guess, just one.
Yeah, exactly. So I think you've covered a lot of stuff here with us, Ethan. Yeah. And I think if someone wants to reach out, I mean, I don't want to wrap it up, but I think if we keep going, we could be here for another hour just talking.
Like, is there anything else that you feel like we haven't touched on today, or any like kind of pieces of pertinent information that we should maybe just get out, or you feel like we've covered?
I mean, it's pretty. Yeah. We've had a pretty broad conversation about kind of like everything, but again, it kind of comes down to every client scenario is a little bit different. And that's the joy of this job. Nothing's like, the only thing constant is change. Yeah. Right. And and everything's different. Every file, you think that it's going to be the same. Oh, I've dealt with this, but then there's another kick somewhere, right? So like any time, if anybody wants to reach out, call, have a conversation, text, email.
So if somebody does want to do that, can you let us know, first of all, if you can just repeat your company name, give us some of your social handles or your phone number even would be great.
Yeah.
Anybody to reach out?
Ethan Jobb, the Legacy Lending Team, powered by Dominion Lending. Our website, legacylending.ca. Okay. My email, ethan.jobb@legacylending.ca. Phone number 289-927-3702. Okay. We're on Instagram. We got we're kind of focusing on our Instagram stuff, legacy_lending_team. So you can find us there.
We'll be tagging you in all the posts, don't worry.
Yeah.
Make sure people can get you there.
Like I'm on LinkedIn. That's kind of like a professional
Yeah.
Facebook side of things.
Yeah.
So that's always good.
So we've had the pleasure of having you in here today. We know you work on a team. They're probably going to want a little bit of a plug. So go ahead, plug away on the team. Who's the most senior person on your team?
Yeah. So starting from the top.
Careful.
Yeah. I said most senior experience. I didn't say experience, did I?
No, you didn't.
No, I didn't. No, I
Well,
didn't.
you know what? She'd be the most experienced probably in Durham region.
was gonna say,
she
yeah,
piloted
she's
the
up there.
program, the mortgage specialist program at RBC
Yeah.
in the early 90s. So
Yeah.
she's been a mentor to myself, my sister, my brother-in-law.
Okay.
It's been great. And that's part of it. Like even starting, I was down the hall, right? So I got to hear conversations and, sit over her shoulder and be like, what are you doing here? What are you doing here? Right.
Yeah.
That was the days when we used to fax in our applications too. So, right?
Sorry, what was that?
Yeah, fax. Yeah.
Oh, fax.
Yeah.
I've heard that before.
So Marlene, and then Alexandra, she's my sister, and then
Yeah.
Dave Stone.
Yep.
So all of us together, you can reach any of us. We all kind of work the same. We're family. That's a huge, driving factor for all of us to make this jump too.
Yeah.
Without the support of our family and being able to do it together collectively.
Yeah.
Mutual commitment, right?
Like we know how to talk about mortgages and do mortgages because we knew one product. We
Yeah.
can still have that same conversation, but now it's like we have so many different lenders and different portals and kind of things to go down. But Scott, I'm sure with your family, people love that, right? Like you got your son in it now, and you have more experience than he does, but he can learn from you and you can.
He actually connects better with some of the clients than I do.
Yeah.
Right.
Yeah.
Because, well, he's obviously coming from a younger demographic, but here's the thing that's surprising for me is that a lot of my clients that are at retirement age or just beyond retirement age absolutely love him.
Yeah.
Right.
good.
Absolutely love him. And, they almost kind of like, was Ethan coming? Right. And I'm like, all right,
The
I
old
guess
guy
I
here.
guess I don't need to be here anymore.
Yeah. Yeah.
Hey,
But
that's okay though, right?
No,
That's frees up
it
your
is.
time.
It is good for him. It is good for him. So that's why I understand, like, when you've got that hierarchy of, you guys working, and it's not even a hierarchy. It's just
Yeah.
Yeah, we're
Marlene's
all-
team.
Marlene's at the, got the most experience, and then it's been trickled down to you guys.
Yeah.
So that's wonderful.
Yeah.
But it's the same thing, right? Like just like, this Ethan was mentioning and the same thing that your Ethan has experienced is that, he's been in the environment, right? He's been in the car with you, just like he's over his mom's shoulder when he's a kid, right? Like these are things that they're like, you guys were learning these things without even realizing it, right? And it's just like natural because you're exposed to it, right? Like you see it happening, right?
Yeah.
So
And it's funny because he and I will butt heads harder than if it was somebody else.
For sure.
Right? Because the conflict is there and you're not worried about hurting feelings.
Yeah.
Oh, I mean, you're not
Yeah.
being belligerent with each other, but you'll go harder at one another, trying to make your point or getting him to get motivated or getting me to understand social media.
Yeah.
Right?
Yeah.
Because, there's a very funny story about when my social media kind of changed. And one of the agents here was like, he goes, "You're not doing it anymore, are you?"
Yeah.
Who's
Right?
that?
And I'm like, "Yeah, no, I am. And he's like,
swear.
"No, you're not," because your son's doing it for you. And I was like, "Yeah, he's doing it for me. Yeah, all right, fair enough." So, no, it's nice when you can keep it in the family, and we really appreciate you coming in today.
Yeah, it's been a blast. Thank you.
thanks for
giving
having
us
me. It's been great.
giving us a ton of time here today to talk about this. Please do reach out to Ethan if you have mortgage questions. He and his team are going to take care of you.
Yeah, so just finally, once again, we'd like to thank Ethan for joining us today. Anybody, you're going to have his information on the posts. Anybody who's listening, we really appreciate, as always, all the feedback, all the great reviews we're getting on Spotify, Apple, Amazon Podcasts, everything. So,
Well, and we just, with great guests like Ethan, we've just crested over 500.
Oh, wow.
Right. So
moving up.
we're really happy about that. So we're getting some good traction. And I think a lot of that is due to our good guests that we bring in.
Yeah.
'Cause
Well,
they're
good
very-
hosts.
Oh, we
So
try,
I'm
we
gonna
try.
try and pull off this DJ thing again and walk us out with some music here. So bear with me for 1 second.
And
So,
as you do that, just lastly, like we always say, right? If anybody has questions for Ethan, and they don't want to reach out to him, feel free, send us a message, give us a comment. We do have plans to bring him back in the future. So let us know.
Yeah,
We're here to keep you up to date.
You guys can always ask me the questions on
Exactly,
behalf.
yeah,
It's,
for sure.
Again, we sometimes can uncover more or speak more specific to the client. But yeah. It's great anytime.
No, it's been an absolute blast. That time went by like that.
Yeah.
Like it was just
And
fantastic.
a lot of great information. So yeah.
Thanks, guys.
Thank you.
Take care. Have a great afternoon.
Yeah, let's all have a good weekend, eh?
Yeah.
It's Friday after all,
Happy
isn't
Friday.
it? I think so.
Sounds good. I'm all over it.
Yeah.